Good morning, ladies and gentlemen, and welcome to the show. I'm glad to have you guys here today on Wednesday, the 9th of June, 2021. Thank you for tuning in. Now, one of my viewers yesterday asked me a question about why inflation? Why is it going to be inflation? Why not deflation? And I'm going to try to explain that right now. And to understand the reason why, first you have to understand the full context of what's going on. Go back to the year 2008. When we had what was called the Great Financial Crisis. The thing is the system started to melt down. And they said that if they hadn't have stopped the meltdown, within 2 or 3 hours, the system would have melted down. Well, what does that actually mean? It means that the system in 2008 was over-leveraged with a lot of derivatives, tremendous amount of derivatives. Also, there was also the multiplier of money where they take out more and more credit, and we call this fugazi. That's what we call it in the but actually what it is it's over leveraging the system with credit, which is actually debt. In other words, there's an awful lot of money in the system that's in margin or on margin. A deleveraging of the system is a normal process in which the financial system finds stabilization. But they didn't allow that to occur in 2008, and the crisis that would have ensued in 2008 if they had let the system completely collapse and melt down, the system would have basically locked up and frozen. And they knew this, and it would have caused a crisis that would have been unparalleled. The whole world's financial system would have basically, meltdown. Just about everybody goes bankrupt. So what they did was they brought out quantitative easing, and they increased the leverage. They basically doubled down. They basically increased the volume of derivatives products, which has been titled weapons of mass financial destruction. They increased them exponentially in those years between 2008 and now. And so if the system was over-leveraged and couldn't withstand a meltdown in 2008, now it's like 4 times. So now at this point, it's gone so far that the people that are in charge, the people at the top, the people like the Federal Reserve, they are absolutely terrified at the prospect of an uncontrolled meltdown starting within the system. So what they're doing now is they're watching everything like a hawk. If they see the overnight funding markets starting to have difficulties, they move right in with either the repo operations. They move right in with a reverse repo or repo operations very quickly, and they solve that problem. If they see a problem in the corporate bond market, well, they buy the corporate bonds. If they see a problem developing in the stock market, well, they'll rush in and they'll do some sort. They're not going to allow any part of the financial system. They're watching the whole thing like a hawk because they're terrified of a meltdown like 2008 would get out of control now at this point. That's what it wants to do. It wants to deleverage. It wants to do a 2008, but only 10 times worse. But they can't allow that to happen. So they're going to do whatever it takes. They're not telling you this. Behind the scenes, they are absolutely terrified. And none of them wants to take responsibility for what might spiral out of control very quickly and very suddenly. And so they're going to do what would be right now considered to be the responsible thing, which is pour money on it to solve any problem that might crop up within the world's financial system. But why they don't want to tell anybody this, what I'm telling you guys is, is because people would say, well, this is going to have to end in hyperinflation, because you just can't keep propping everything up and controlling the entire world's financial system and not letting anything fail. And that's to the point we're to now. We're to the point where they will not let anything fail. If something starts to fail, it could spread within the financial system rather rapidly. And so they're at the point now where, no, we aren't going to let anything fail. We're going to keep it all going. We're going to keep all these plates spinning in the air. It's like the old thing, they used to have this thing where a guy is spinning plates, So this is the way it's going. They're going to keep watching every part of the financial system, and they're going to do whatever they have to do to keep this whole thing running. But that requires even more leverage. That requires even more creation of credit. Ultimately, it's going to keep pushing and pushing and pushing until people start to lose confidence in them, in what they're doing, and in the amount of money that they're creating. And we're starting to see that seep through now. But it's going to get worse. And so we only got a matter of time left, guys, because look around you. I was talking about this yesterday. I was saying that everybody you see, do they really produce anything? But they consume tremendous amounts of everything. Where's it all coming from? Well, a lot's coming from China and other countries, And yeah, there's still being a few items produced in the United States of America. But they're rather few considering the amount of consumption that we have and how much we consume. This is a non-sustainable process. And so what we're headed toward is a different kind of financial crisis, a crisis of the dollar, guys. That's where we're headed. And it's just a matter now of how much time. I've kind of estimated that it's really going to get underway in about a year. And anyway, that's where we're at. So let's get into the markets and let's take a look at what's going on. Let's open up the charts right here and take a look now at the silver price, which is up 28 cents. Now, they've been manipulating silver. And why they're manipulating it is they're trying to get out. They know Basel III's coming. And the bullion banks right now are trying to get out of their unallocated short positions in this silver market. And so what they're doing is they're creating volatility within the silver market. They're creating prices spikes, mostly to the downside, but sometimes a little bit to the upside. And they're creating these wide swings in price or volatility. And they'll continue to do that up until the 28th of this month. I think we're going to see silver and gold start to break free of its chains because the bullion banks are trying to get out. In other words, they want to leave it alone now. So it's going to find its fair market value probably in the not too distant future. So this is a really good thing for silver and gold, and it's really going to be a really good thing for people who hold silver and gold. Anyway, silver price at $27.89 today. Let me take a look at gold today, and the gold price is $1,892. It's up 20 cents, which is almost nothing. Let's take a look at cryptocurrency today, and what we're seeing is it's making bottoms. Cryptocurrency moves faster than all the other markets, and so if the other markets take like a year to make a bottom, cryptocurrency can do it in 2 days. Everything is like 10x fast. A hyperspeed market. And so we're looking at a Bitcoin price today of 36,481. Cryptocurrencies right now, they've went through this, I don't know, it's almost like a lot of FUD came along, and then a lot of short selling, and we had seen a price of 64,000 on Bitcoin drop down to 30,000, and now it's starting to creep back up a little bit, and it's made a couple bottoms and stuff, and that's what we got going on with cryptos. Let's take a look now at the Dow Jones. It's 34,513. It's up 13 points on the day. Now let's take a look at crude oil. And crude oil is $70.06. So guess what? We've cracked the $70 mark on crude. And so now our next target is 80 bucks. Now let's take a look at the MOVE index, and we're seeing it's going along flat or sideways today. It's dropped a little bit, 10%. It says, but I don't see where was it up to drop 10%. It was 40 yesterday, and it's 40 today. Did it have a little spike upwards or something? It says 5.55%. Basis points, and it's 10% drop it's showing there. Okay, so anyway, it's 49.93 today. Let's take a look at bonds and rates. And here we're seeing it. Bond yields are falling again today. We're just barely keeping the 10-year above 1.5. And it's moved down 2.7 basis points. Now, I showed you yesterday, it's like a sawtooth, you know. It's like a saw pattern. It goes up and down, up and down, up and down. But the general process is downwards, you know. And so now we're seeing yields falling again. And we're starting to get, like, you know, we were up to, like, what was it, 1.75 on the U.S. 10-year not that long ago. And now it's 1.5. So it's 2.17 on the U.S. 30-year today. It's down 3.3 basis points. So it's falling on the long end today. Let's take a look now at the U.S. dollar index, and what we're looking at is 90.09 and just barely keeping its head above 90. But what's it being compared against? A bunch of other fiat currencies. And so all of them are doing bad too, you know? Anyway, listen, guys, thank you for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.